Hello, and welcome back to my channel. The first video I posted was an introduction to the Uniform Token Regulation Act and how states can work together to provide regulatory clarity in the blockchain landscape. We focused on state statutory examples that provide pre-sale disclosures for utility token offerings. Utility tokens specifically because commodities like Bitcoin will be regulated by the CFTC and securities will be regulated by the SEC. But a utility token is unique and different, and it's important that we distinguish these tokens separately because a utility token is more of a token that you use to access or pay for a service. Um, so one of the things that we just should get out of the way is that the Uniform Token Regulation Act could be um, a basis for states to create legislation, but it's not required. Uniformity is not required, and states could adapt the statutes to their current legislative scheme to make sure that the rollout can be as efficient and seamless as possible. So, like I said, we want the state to fill the regulatory gap, and how they'll do this is by creating opportunities for clarity in regards to utility token offerings. So what's an example of utility token? I'm sure you're curious as to it. Is it just a token to pay for a product or service? Well, let's jump right in. A utility token is a prime example is going to be Filecoin. Filecoin is a decentralized storage network, and it is where people buy and sell unused hardware space. So a brief overview of how Filecoin works is that the Filecoin FIL token is used to pay for storage space, used for retrieval of stored data on the Filecoin network. And one of the ways that we distinguish a utility token from a security token is that the utility token is not intended to represent ownership of a profit share. So a security token is usually linked to promotional statements that say this is an investment where we project that the asset's going to go up in value. Whereas a utility token is saying, hey, we're going to give you an asset to purchase, and then you could use that asset to pay for services that we offer on our network. Here, it would be paying for storage and retrieval of data on unused hardware space. So as a brief summary of what a utility token would be is the primary purpose is access and usage. So the token could go up in value, and that would not immediately deem that token a security token or deem it sold pursuant to an investment contract. The courts look at it as what was the primary purpose of the marketing of that token, and how is that token used primarily by holders. Courts would look at it saying, okay, what's the average amount bought by users? Um, what's the rate at the which users actually use this asset to pay for the services offered, excuse me. And another important thing is we were talking about how it wouldn't be deemed a security just because the asset goes up in value is what was the marketing and promotional statements like coming from the initial development team? Well, you'll hear me refer to that as IDT. Um, is the marketing information that they provided to potential users something that says, buy this token, we're doing consecutive sales, this pre-sale offering is going to be sold at 25 cents a token, whereas the next one we're projecting 50 cents a token, and the next one thereafter $1 a token. Are there different tranches for these offerings? Are the investment materials promising promotional statements that provide a reasonable investor to expect his asset to rise in value over time based on the efforts of the managing team? And also, a really important thing is the network functioning at the time of sale or at the time of purchase? Really, an important thing is that there was recently made an innovation exception by the current SEC chair, Paul Atkins. He was talking about how certain companies are able to raise money if within a 24 to 36-month period, the network is reasonably likely to be up and functioning. Because, like we said, it's very difficult for startups to expend capital, lawyers, attorneys' fees, bankers, the way to get all these offerings done. So we want innovation to stay onshore, and we want people to make sure that their assets are safe and secure, excuse me. So what would the sale conditions look like if they're not sold pursuant to an investment contract? Um, we really look for the term speculation. Are these investors reasonably able to rely on the increase in value on the token, and is that their main reason to purchase it, or are they purchasing it in amounts that it's indicative of them actually using the token for the services offered by the platform? This is not a determinative factor. This is one of many factors that the court will look at. But if the, excuse me, if the sale conditions imply that investors are purchasing them in amounts uh, that indicate that they would use those for personal or consumptive purposes, not investment purposes or speculative purposes, the court is less likely to lean towards an investment contract and therefore not subject to securities regulations. So states should not wait. And I've been repeating this in my first video. The states should not wait for regulatory clarity because not only does it move money offshore, but it localizes the market to incumbent financial service providers, and that's going to harm the consumers in the end. Not necessarily because they're not going to get the products they need, but because there's not going to be a lot of diversity in companies that are offering their services. And one of the best value adds is diversity when it comes to these companies because we want natural competition. We don't want monopolies in the space, and we want consumers to get the opportunity to make informed decisions in a market that reasonably responds to all of their unique needs. And if we have a couple financial incumbents already dominating the space, it's going to reduce the possibility of new players coming in. And that's a moat that we don't want. And we believe that I believe that it can be readily prevented by a Uniform Token Regulation Act. Excuse me. Um, So an example of why consumers want regulatory clarity on what assets could be securities is because an asset that has been available for purchase, a digital asset that's been available for purchase since 2013, and then 7 years later, someone comes around and they have high regard from the SEC, comes around and says, "Oh, this asset's likely a security," and then they get a Wells notice from the SEC basically saying like, hey, you're under review. You might have sold these assets pursuant to an investment contract, and therefore you owe us fines, and they get an extreme amount of money. Markets don't really respond well to a company that has been operating in a vague landscape, being given a Wells notice by the SEC. And a prime example of this in detail is what happened with XRP, Ripple's native token on their network. So specifically in a little bit of history, in 2020, former commissioner, or on his last days of commissioner, Jay Clayton came out and gave Ripple an enforcement action. That was the Wells notice saying that their tokens may have been sold pursuant to an investment contract and are likely a security. That token's price fell within a day by 30%. Given XRPs existed for 7 years prior to that enforcement action, investors were blindsided. Consumers didn't know what to do, and they just saw their token's value drop precipitously based on an almost arbitrary action. Because why was it 7 years too late? Why was there little indication in the market that XRP was working with the SEC? This is not something that the SEC is meant to do. The SEC is meant to provide investors and offerers of assets um, guidance and clarity to ensure that investors are protected from fraud and investors could offer products subject to the relevant regulations. Interestingly enough, in this case, we had over 12,000 XRP investors come out and try to intercede in the court, giving their own opinions as to why SEC shouldn't be regulated as a security, and if it is, and if it is indeed sold pursuant to an investment contract, that this wasn't the way to do it, and they showed investor harm. And the court was unwilling to allow those 12,000 XRP holders to intervene. This became a really pronounced issue. And I believe that's why the pendulum is swinging so far from Jay Clayton and Gary Gensler's SEC actions to the now actions of Paul Atkins. So the harm isn't just limited to the holders of XRP. Current SEC disclosures aren't even efficient to determine the financial health and provide important disclosures to investors of utility tokens or securities tokens. And this is because the sphere is changing, and a lot of the ways that um, these issuers convey their financial health is not necessarily the same way that companies um, similar to Facebook, Amazon, or Google are going to convey their financial health. Specifically, current regulations focus on assets and cash flow, uh, thinking about a balance sheet uh, um, and an income statement. Sorry for the pause. Basically, we're not going to evaluate companies based on strictly their financial health from the issuer's perspective, because the token characteristics may significantly differ just based on the revenue it's producing, how much money it's pulling in each month, and where the assets are sitting. Really, to provide a comprehensive picture for a specific token, we're going to need the following, and I'll try to make this as easily digestible as possible. Token holders are going to want to know their governance rights, how much input they actually have in the future of the token. Usually you'll see a lot of shareholders have the right to vote, but one of the most common things is that shareholders usually there's just a lack of motivation to vote. They hold a couple of shares. It's a real impetus to get people to actually vote because they're like, why am I going to listen to the meetings of the company? Why am I going to try to get involved and elect certain directors? Why am I going to put in the effort to understand which director is going to lean one way, which director is going to lean another? And more importantly, most investors of large companies are giving proxy votes to the ETFs where they hold their shares. So there's a there's companies that hold 5 or even 10% of voting shares for large publicly held companies. And then ETFs or big companies like Vanguard and BlackRock and State Street are just going to vote on behalf of the directors that they care about. So that's a localization of voting power, and that really limits the governance rights of individuals. So really, governance is extremely important. Some would say just as much in regards to regular securities, but it's something that could be more easily attainable for individual users on utility tokens because they're going to be able to see their assets on chain. And with companies like Coinbase and Kraken working to launch ICOs, Coinbase is coming out with an offering for the Monad token. That's going to be coming out soon. This is not an offer or an endorsement of that product. This is strictly for educational purposes. I really have to make that clear. And then why are governance rights so important? We want to know the level of decentralization that's involved in these companies. Some things like node distribution, how the voting is calculated, how transparent the voting is, whether there's individuals who hold 30% of the tokens outstanding on the market, whether that's sufficient for them to pass a vote, whether they need 51%, what level of threshold is required for these people to get together, and is there still a collective action problem? These are questions that need to be answered, and regulations could easily solve a lot of the issues that are present in just this space individually. Another thing that's really important for holders of tokens that current SEC disclosure rules wouldn't necessarily fully capture would be the tokenomics. We would want to know if it's a fixed supply, whether the asset's inflationary, whether it's deflationary. Specifically, if the token's inflationary, what's the inflation rate? How is it possible for the inflation rate to change? What level of governance vote would that take? Would it be just 51%? Would it be 66%? And then also if it's deflationary, where does that asset go? Does it go into a treasury that's locked up? What is the ability for the company to access the funds in that treasury if they are burned, and that thus makes it deflationary? these are questions that won't necessarily be solved by current SEC disclosure requirements. You know, we would also token allocation would roughly be properly addressed by current SEC disclosures because we want to know SEC requires people holding more than 5% display or disclose how much of the asset they're holding of the outstanding shares. But in regular securities laws, there's maybe a couple of exchanges like the New York Stock Exchange or the Nasdaq. Um, and with crypto, there's a lot more exchanges out there that have liquidity of these assets. We would want to be able to obtain easily verifiable and actionable information of the liquidity on these exchanges. And this is something that, like I said, current SEC disclosures wouldn't be able to properly identify. Another thing that really is important to uh, uh, digital asset holders is what's the network activity look like? Is How many daily active users are there? Is it just measured by the amount of wallets? How easy is it for one entity to create 100,000 wallets or even 100 million wallets? What if one entity is just using those wallets to send money back and forth to make it seem like the network is actually active and functioning? Um, we really want to make sure that the way that they calculate active wallets and number of transactions is fair, not misleading, and open to audit reports. And those audit reports that verify how much those transactions are being conducted by wallets owned by individual holders, or maybe 100 wallets owned by one person. That might get into levels of decentralization and privacy rights, but there should be an opportunity to discuss this and see whether these audit reports could identify key risks between a couple of holders grouping up and controlling the governance supply of individual tokens. Another thing that really doesn't get focused on current SEC disclosures that would be important for digital asset issuers would be the developer activity. A lot of the things that people focus on and they really report highly about why they like Ethereum is that it's a high developer retention. There's a lot of developer activity. There are people building on it, and that's a powerful metric to determine what asset is growing and whether that's growing at a reasonable speed, and whether there is volatility might indicate that that's less of a safe investment. These are metrics that are not easily obtainable. Some companies like Dune.io would be able to give you that information, but not too many investors or not too many people even familiar with the space are active enough to go through all of these different websites and verify that information on a consistent basis. Um, that would be incredibly important and incredibly valuable for investors of the space. And then also we would want to know how interoperable these different chains are. Financial health of the issuer, that's really the basis for current SEC disclosures, is not going to focus on interoperability and the number of dApps on the chain. They're not going to focus on, oh, the money on this on my Ethereum can move between other chains like Polkadot and Bitcoin. How am I going to be able to wrap the token? What if I want to transfer money to Index Cooperative? There's going to be a lot of questions about this, and that's something that's valuable because liquidity and the ability to move your money around is a real and tangible need. And that's an incredibly valuable asset and something that really should be um, disclosed to investors, and that should be required by what we would call new SEC disclosures. So just review traditional SEC focus is on the balance sheet and the income statement, the financial health of the issuer, its management and corporation risk. Like I said, whether it's just one individual who controls a lot of the um, push of the company, whether a lot of that risk is inherent in one person, whereas digital assets don't necessarily have that same to the same degree as just that one person problem, although that could easily be the case. And then also the disclosures affecting marketing risk, they mainly focus on environmental, um, the regulatory landscape, and the events materially affecting the issuer. But that's all issuer focused, whereas the digital asset focus would focus on the token utility and the function, how that token is marketed, how it's identified, what its use case is, what its when I mean use case, the sole use case, like why people are initially purchasing it, whether it's for consumptive purposes or investment purposes. Investors would want to know the tokenomics, the marketing incentives, the number of validators. They would want to know the protocol design, the governance, the code risk, whether there's bug bounty programs, audit reports, whether this information is easily attainable by investors through a website search, and they make sure that the information that they're receiving online from their investigations and due diligence is verified and safe and secure. They would want to know some things like network metrics and activity, like the daily active users, the transaction per second output, whether it's low latency, the total value locked on the platform, what the gas fees are, how they range, how the gas fees are determined. These are all things that would likely benefit from a modified disclosure, maybe by the SEC if it's a security token, or maybe the state could offer these disclosures for something like utility tokens, which aren't necessarily going to be regulated by the SEC or the CFTC. Um, at the end of the day, digital assets require less of an issuer-centric focus and more focus on a more comprehensive focus on the entire company, and with a strong focus on what kind of function the asset has and who and who's using the asset for what and how many people are using that asset across different areas in the blockchain space. Now, just to not get too wound up, we're gonna think about why why would the digital asset space benefit from a safe harbor? Well, simply some of these assets aren't securities, and a lot of these digital asset issuers are unable to deal with Wells notice or compliance problems going in the future because they don't know how their asset is going to be treated by the SEC. Now we have a more favorable SEC with Paul Atkins, but in years to come, that might be different. And companies that are investing tens of millions of dollars or even hundreds of thousands want regulatory clarity. So the primary benefits for these digital asset disclosures in a safe harbor would be reasonable and comprehensive, reliable token data. We would get the regulatory certainty for these safe harbors, and we would encourage innovation and decentralization among these group projects, thereby mitigating the risk of just the financial incumbents benefiting, which eventually and hopefully would lead to more companies entering the space and providing a more comprehensive approach to the unique needs of individual purchasers in the space.